SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, Managing Partner at Search Fund Ventures and CEO of SMB Investor Network. And today I'm joined by Matthias Smith, CEO and founder of Pioneer Capital Advisory. Matthias is an expert in all things SBA lending. He's a top-tier loan broker for folks that are looking to close deals and small business acquisitions, and he's going to shed a lot of light on what that SBA loan process looks like, business plans, and even talk about some of the SOPs with us today. So with that, Matthias, I'll kick it over to you to give an intro.
Sean, thanks for having me. Definitely glad to join you here and be on your podcast. I appreciate this. Yeah, so give a background myself and Pioneer Capital Advisory for anyone watching this podcast. So Pioneer Capital Advisory is a bespoke boutique commercial loan brokerage firm that consists of myself and 6 other people. So Valerie Stash, my chief operating officer that leads the logistics and the KPI, kind of overseeing the day-to-day of the team. We have 2 inbound sales consultant type folks, Rafael, who's based in Brazil, who does outbound sales, and then Alan, who is based in Monterrey, Mexico. And then we have 3 analysts. So my director of credit, Pablo, based in Monterrey, Mexico, Fernanda, also based in Monterrey, and then Ramiro, based in Buenos Aires, Argentina. And essentially what we do, Sean, is we help business buyers from the time that they're under LOI or super close to LOI with navigating the SBA financing process. There are $31 billion of these SBA loans that get done each and every year. And the problem, or the crux of the problem when you're a buyer, is knowing which bank or which lenders to pitch your deal to get the best credit terms, the highest degree of certainty to close at the point in time that you're under LOI. And that's where we come into the mix to help the buyer go through that. I'll just pause there.
Yeah, it's really important because, a lot of folks are first-time buyers and many folks are just going to be one-time buyers, right? So navigating that SBA loan process is not a skill that really anyone's an expert in other than yourself and SBA lenders. Maybe, if you could talk to us a bit about some of the key steps in that process. We talk a bit about the business plan, all that. What does it take to get the SBA loan?
Yeah, no, for sure. Let me I don't know if Riverside will let us do this, but let me try to share my screen here super quick, and I'll just show this deck. I didn't screen share on Riverside before, but I think this should work. So basically kind of a high level map or overview of the process to be able to done. Basically the first step in this whole process is finding the deal as a buyer and getting a deal undersigned, ideally exclusive LOI. And so basically the requisite to get the bank financing and to get the equity dollars, and that's where you, Sean, your network come in, is actually having the deal in hand. So once you have the deal, and kind of speaking from a standpoint of our process flow to kind of integrate that into the broader question, is we would kick off our process with an engagement letter that would go to the buyer essentially to establish that we would be helping them go through the SBA financing process, pitching their deal to banks that it's a good fit for, and basically kind of helping them shop the debt. But speaking more broadly as to the process as a whole, once you as the buyer have the deal and you kick off the financing process, so you have everything really needed to start the process, which generally, and there's kind of some nuance and variance here from one bank to the next, Sean, but it's typically the financials for the business that you're buying, the last 3 years of business tax returns, current interims, ideally a prior year full income statement, broke out monthly, so that the SBA lender can do what's called a trailing 12-month analysis, your personal financial statement, tax returns, resume, something showing your current credit score, the broker listing, the signed LOI, your requested source and use, etc. So basically, once you're in underwriting, kind of using that as the initial starting point, Sean, the process, broadly speaking, at least with us, it comes down to about 74 days start to finish, start of underwriting to approval. And where that really kind of shakes out is, typically speaking, with many of the banks that we work with, it's about 3 weeks plus minus, sometimes 4, to get from the start of underwriting to an approval. The requisites to get into underwriting are having all those financials and items here on this slide, in addition to having a management plan that explains what the company does that you're ultimately buying. What does the human capital organizational chart look like within the business? What does the seller currently do in the business? What do you as a buyer plan to change after you buy the business, Sean? And then also talking about, competition, the end customers, and any of those finer points that the bank's analyst and underwriter will really need to understand to fully put together a solid credit memo, as well as putting together a 3-year financial projection. Once you have all of those items, typically, this is a lot of back and forth, answering questions from the analyst of the bank, trying to really get the analyst comfortable with the deal, your management plan, how you ultimately plan to run the company. And then once the deal gets approved, typically, and there's some variance here bank to bank, is a closer at the bank will get assigned to the file. They will put together a definitive list of what you as a client needs to put together to ultimately get to a closing. And that list will entail everything from a purchase agreement to down payment documentation, business insurance, life insurance, lease agreements, corporate documentation, a whole hodgepodge of things. And generally speaking, Sean, the biggest driver of getting to the closing once you're approved is getting the purchase agreement done. Now, if you have a third-party landlord, for those listeners of the podcast that aren't familiar with what that is, if you have someone that owns the building other than the seller, and you have to kind of navigate through the mechanics of figuring out the lease situation there, that can add time to the process as well. But generally, this, with us, with Pioneer specifically, I'd say 74 days serve underwriting to closing. But I'll just pause there.
Yeah, that's a great outline of kind of the process. And I think it, just underpins how much work goes into many of these deals before they even land on an investor's desk, right? I mean, a lot of times, sometimes we see a deal probably at a similar time as you, Matthias, but other times we see it after your team or another SBA, lender has been working on it for a substantial amount of time. And just to know that all that kind of, not only paperwork, kind of execution level work, but also the business planning and kind of the underwriting that's gone into it. It certainly can, I think, add confidence to a lot of folks' processes.
Yeah, and one thing I would say there too is, as an investor, especially if you're investing with these for your first time, you can't assume that the bank is doing the diligence for you. So the way I kind of explain this, even when I talk with sponsors or buyers, Sean, is what the bank is really doing is they're taking the inputs that you're giving them as far as financials go, business plan, resume, etc., and they're overlaying the pro forma or proposed debt structure as the denominator, with the historical kind of earnings structure and projection as the numerator, to see, would this business have cash flowed with the historical financing structure based on what you, buyer, are planning to take as a salary. And so the kind of more forensic quality of earnings accounting type probe that is ultimately very important. The bank isn't really a party to that, but sorry to ramble here.
No, it's good to understand that. And I think what's also important is, to your point, the bank's underwriting approach. There's some pretty stark contrasts between underwriting a business and a person for an SBA loan versus underwriting a business and a person as an equity investor. Because as an equity investor, you really want to see a great value creation plan. You want to see growth. You want to underwrite that forward-looking projection with growth involved, so you hit a good IRR. The lender hits their IRR as long as the payments are made, and there's not really upside beyond that, right? Unless you're an SBIC and you've got warrants or something like that. In SBA world, the interest rate is the return profile, so you just want to make sure the business can pay that.
Yeah, and one comment there as well, trying to keep sprinkling as far as the projection goes. So the bank, at least historically with many of the banks I work with, they don't allocate heavily in their approval decision-making process to the projection. Many of the banks more or less want to understand how you're thinking about things, from are you planning to add marketing spend? Are you planning to increase the labor force and things of that nature? But the vast majority of the approval decision is very much based on the historical financials. And the business plan, I'd say, has a greater allocation of the credit decision-making, but a very less extent to the projection. Whereas to the comment you made, as an investor, the projection is super important.
Yeah. So, to talk a little about the business plan that folks prepare for SBA lenders, I'd love to get a sense. You kind of talk through some of the key sections. What are kind of the focal points for lenders in that business plan? And we can talk a little about, how equity investors typically look at business plans as a contrast as well.
Yeah, of course. So the biggest thing is, first and foremost, really understanding what the company does that's being acquired and, who the end customer is, what the product or service is, and then how are the sales actually being generated, Sean? So is the seller the linchpin or the focal point to sales generation, which in many of these companies they ultimately are? Or is it someone else or multiple people within the organization as their team generating the sales? So that's just kind of aperture, I'd say, the foundational understanding the bank really wants to have. And then from there, really drilling into the organizational chart and who's doing what in the business. Basically, what is creating this enterprise value within this SMB, and what do you as the buyer plan to do after you take control and ownership of this business? Are you going to kind of keep things steady state and do kind of more of the do no harm approach, or are you planning to kind of make small modifications within the allocations of responsibilities and goals of each of these people to try to create more value? And sometimes, candidly, I mean, this is more rare than common, but I've seen it done, is some people have more of the Elon Musk style approach where they're really going to go in and shake things up. So I worked with a guy before. I'll try to be vague on what he bought, but essentially there was a very overpaid front desk person where they're making like $25 an hour, not really doing a whole lot. And he went and bought this business within 3 weeks, replaced them with someone in the Philippines who is not making $25 an hour. Those are, generally speaking, what I tell buyers is the bank likes to see more of the do no harm approach. But if you plan to shake things up, just account for the fact that that could result in a dip in earnings depending on how things go.
Yeah. And I mean, we frankly, as an equity investor, will virtually always underwrite at least a certain case to have a pretty substantial dip in earnings post-close. The transition period is always rocky, frankly. And it's interesting to hear. I think that's a commonality, at least in our underwriting approach, and it sounds like lenders' underwriting approach. What probably differs a bit is we'll look for some type of secret sauce in the deal or a competitive advantage that can drive really great upside, or what we call an asymmetric bet, right? So maybe that's a large roll-up strategy that the sponsor is uniquely positioned to capitalize on, or maybe that's, a tech enablement approach. My sense is lenders probably aren't as interested in seeing some of that stuff in the business plan, and maybe that's something that could cause concern if it's going to add a lot of risk and expense.
Yeah, what I would say there is like the roll-up strategy, anything that doesn't really get too technical, most of the banks can understand. So like, let's just say, for example, there's a lot of fragmentation in the market currently, and you can kind of capitalize on a roll-up strategy. They will allocate somewhat to that from like understanding the plan, but they're very much interested in the historical scenario. So
it's great. So maybe, we move on to talk a little bit about some of the more recent changes to the underwriting guidelines and kind of the SOPs that have been released recently. So there's kind of, been a couple waves of updates, right? And I'd love to kind of get your perspective on how some of these broader, more sweeping changes might impact both buyers and investors.
Yeah, so a couple things. I guess I'll start first with just to give a kind of roll back in time. So just to give a historical lens here. So before the start of this year, kind of using that as the initial snapshot, Sean, the status quo in these deals is basically 51% of the ownership group of any business financed with SBA financing had to be owned by either U.S. citizens or green card holders. And then the other 49% could be owned by non-citizens and non-green card holders. So on March 10th, basically the SBA put out what's called a procedural notice. And so procedural notices essentially modify the current SBA guidelines that are in place, which are called standard operating procedures. And so this procedural notice number, which came out March 7th, essentially modified the guidelines where now 100% of the ownership group in the SBA deal has to be U.S. citizens or green card holders. And the lender, when they input the deal, so deal meaning loan, into the SBA system, pull the SBA loan approval or loan authorization, they have to input the information for at least 81% of the ownership group. So for people that are watching this or kind of listening to this as investors, that's kind of the first most important thing, is that now a requisite to even invest in one of these SBA finance deals is that you have to be you have to be a U.S. citizen or a green card holder, where that didn't used to be the case. You could be part of that 49% of the cap table. So that's the first biggest change. Other changes that I can think here, Sean, are relevant specifically to this audience. So one is some of the, as you know, basically a lot of these SBA deals now have equity syndicates that are involved. So you might have a fund, right? Like there's Slackwater Capital, Ben Bortner, there's Workbench Capital, Tony Capper, and many others as well. And so the onus really is on the GP or the general partner on validating, the citizenship status or residency status of the people in their investment syndicate. So if you have 100 people or 80 people, I mean, that's a big risk on you. If you're signing off on something for the bank and different banks are wanting to see different things, basically to validate the status of all the people in the ownership group. And so I think some of these equity syndicates, either one, there's going to be more initial KYC on the investor side that the GPs are going to ask for up front to validate the status from a residency standpoint or a citizenship standpoint of investors, or some of the GPs where they just don't want to do it or deal with it, or just going to peel back from SBA financing perhaps for the next 4 years or until the guidelines change again. So that's kind of one thing to highlight there. Aside from that, as far as the down payment documentation goes, in the most recent SBA guidelines that are going to be going into place here effective June 1st, basically now there's going to be the requirement or the requisite of showing where the funds were going into the actual deal 30 days before the transaction closes. The current SBA guidelines, so we're filming this here May 7th, 2025. So the current guidelines, which stay into place until June 1st, allow the bank discretion on what they want to require. So some banks don't require bank statements from investors or the sponsors, others do. But now across the board, the bank is going to have to paper back where the funds were that went into the transaction 30 days before closing. So my personal thesis here is kind of one of two things. So one is general partners that want to continue investing in these SBA deals, but don't want to hassle their investors for their bank statements because some people just don't want to share those with the banks, will likely call capital at least 30 days before closing, because then you just have the funds sitting in your account and it's just providing one statement to the bank, which is a lot easier, especially from a privacy and data sharing standpoint. Or two, some investors that are super high net worth that don't want to share their bank statements and can't be bothered, just won't want to invest in these. But I'll just pause there. There are, I guess, two other specific changes specific to the down payment on capitalizing these deals that I do think would be interesting covering, but I'll just open this back up to you with any questions or thoughts on that.
Yeah, no, it's good timing. Those are two really good points. So first, on the shift on foreign ownership requirements, that has certainly been, I would say, impactful to a lot of folks in our network. It's caused people that were, I would say, had the intent to invest in SBA-backed deals to be unable to do that. And we've been, for our own purposes, doing a lot of work to think through, can we admit, non-U.S. citizens, lawful permanent residents to the fund? Are there mechanics to create parallel funds? There's a lot of structuring stuff that would now have to go in, which inevitably increases complexity and adds a lot more expense. So that's a great call out. And then, on the second piece, the strategy to call capital substantially earlier than kind of the deals will be closing is certainly the approach we've taken. I think it also warrants an approach of having more of a sort of scheduled capital call cadence as well, so that there isn't kind of this mad rush. And then, like you said, everyone needs to kind of provide a look through into their bank statement. So really good feedback.
Yeah.
Good.
Yeah, and even for the banks too, Sean, I mean, the banks don't want to do more work than they have to. So it's honestly beneficial for the bank too to have the capital call take place earlier, because I've been a closer at these banks before prior to starting Pioneer, and some of these equity documentation packages, I mean, were hundreds of pages in length, if not more, having to show where the funds went to the account and then just showing the whole paper trail. It's honestly a pain, quite frankly, for the bank, just from a labor time standpoint, to have to go through it if they don't need to.
Yeah, so that's good. to know as well. And I think the takeaway for investors, passive investors specifically, is if you're going to be investing in SBA deals, you got to get your documents in order early on, and you want to be prepared to submit all that as quickly as possible. The last thing you want to be is the reason a deal gets delayed, right?
Yeah. One other thing to call out too, Sean. So I actually have a couple of deals now that have investment kind of equity syndicates or funds involved. Is the bank now essentially has to pierce back to the beneficial ownership level of these deals to show who is actually in the cap table to get to that 81% in the SBA's E-Tran or capital access financial systems. And so they're asking for, the name, the address, the birth date, and in some cases the social or EIN for these beneficial owners, because the SBA really wants to make sure that the guidelines are being followed and there's not any funny business going on.
Yeah, no, it's good to understand for folks that, are starting to dip their toe in the water in this space. Let's talk about the other two kind of big changes, largely related to down payments and ownership as well.
Yeah. So one is, I'll start with rollover seller equity. So under the old SBA guidelines, well, technically the current SBA guidelines, which go through June 1st, which is not too far off here, you as a seller, if you're buying a business as a buyer, there's a concept of what's called rollover seller equity. So that's the kind of terminology used in the private equity world, or in the SBA world, they call it the partial buy-in, where you as a buyer buy majority ownership of a business. Instead of buying 100% of a company, perhaps you buy 90, 85, 88, whatever, and the seller keeps less than 20% of the business. Now, a lot of people, Sean, were doing this for two different specific reasons. One was to bridge valuation gaps. So basically, the business would value out at A, but the seller really wanted B to sell the company, and there was just a delta between what those two numbers were. And so the buyer, the SBA provisions that the buyer can get financing from the SBA bank up to what the third-party valuation comes in at for the business. But any deficit or kind of variance has to be plugged by buyer and investor equity, seller financing, or equity roll. And so basically the seller rolling over equity kind of helps solve for a lot of this. Now, the other specific reason people would do this on M&A deals in the SMB space is business licensing. So if you're buying an HVAC company, for example, or an electrician firm or a plumbing company, generally speaking, there's a benefit to having someone that can qualify the license in the ownership group, because you aren't reliant on an external source or license holder where, all of a sudden if you don't have licensing, you can't generate revenue, business operation shut down, and worst case scenario, you end up defaulting on your SBA personal guarantee, which is not a topic of light conversation. And so the way banks were getting comfortable under the most recent SBA guidelines is they would have the seller retain a nominal slug or portion of equity so that you would have an owner in the cap table or in the ownership group that could be the qualifier of the license. So under the new guidelines, Sean, which go into place effective June 1st, if you want to have your seller retain any ownership whatsoever, whether it be 1%, 15%, or 19%, they have to personally guarantee your entire SBA loan for 2 years. So if you're taking a $4 million SBA loan and you want the seller to retain 5% to qualify the license, seller is personally guaranteeing $4 million for 2 years. So effectively, rollover seller equity deals are dead.
Yeah, asking a seller to personally guarantee the amount of money they're taking away for selling the business is effectively,
it's insane. Yeah.
Well, it's they're no longer walking away, scot-free, having sold the business. They're still tied up for 2 years or more potentially. So that's a big change.
Yeah, so just to pop back in there, Sean. So my chief operating officer, Valerie, actually sent out an email to all of the banks that we work with yesterday to ask the banks the question, how are you going to want to see these licenses getting qualified in these deals? And it's across the board. So some banks want to see the guarantor or the sponsor, the person that's the searcher buying the business, be the qualifier. Other banks are fine if it's a key employee within the company that has no equity ownership whatsoever. Other banks want to see the key employee or the qualifier be a minority owner in the cap table. And the responses we've been getting back are super interesting. And the short of it is it's just across the board. So the banks are having to figure this out in real time as the SBA guidelines change. And candidly speaking, I mean, I think even more than the next point I'm going to talk about with the down payment, I think this is a bigger deal because you have all these businesses, especially in the trade space, where sellers want to retire and hand the baton off. And they're basically being asked in some cases by banks, you have to personally guarantee this for 2 years. That's a huge economic risk if you're a 70-year-old stepping back to ride into the sunset to spend time with your grandkids, and you have a searcher coming out of Warden or Amazon that's never run an HVAC business, and you're getting asked to personally guarantee their $4 million loan. I mean, there's no way I would do it personally.
Yeah, I mean, it's sea change in who is going to be truly a qualified buyer for skilled, trades, and really any businesses that require a license, especially if the license holder needs to be an owner. I was just talking with a gentleman who represents buyers as legal counsel, and we were talking about MSA structures for medical practices, and that's a whole nother world. But just thinking about all these types of businesses that utilize some sort of minority ownership to maintain licensing, that's going to change if there's an SBA deal. It's going to more frequently need to be someone who has that license to be the buyer.
Yeah, or even having that person the minority equity table. But the challenging thing, Sean, candidly, I'm sure you see this because you're an investor in lots of these deals, is from a deal dynamic standpoint, kept two things. One, it's typically not until further in the transaction or the deal process that the seller wants to let the employees know the company is being sold. And so then the bank wants to know who's that qualifier going to be earlier in the process. And many banks, Sean, are going to want what's called an SBA Board Information Form or Form 1919 on that individual, essentially to show that they're not a felon, they don't have any weird background stuff going on. And so essentially, as a seller, all of a sudden you're having to make a judgment call. Do you have high enough conviction in this transaction closing to notify your key employee the business is being sold 8 to 10 weeks out before closing, best case scenario, assuming the deal doesn't die based on the QV, whatever the facts. And then as a buyer, you're having to decide, one, if the seller is fine having that conversation, do you feel comfortable leaning enough on this person to be your qualifier such that they're joining your ownership group? And then all of a sudden that changes the whole capitalization of your equity structure and, figuring out, is this person ultimately going to be a good partner? So there's lots of different variables at play there.
Yep. And one of the big risks we always look for really throughout the organization is key person risk, right?
Yeah.
And if you introduce anything that kind of, introduces more of that to a deal is something that will make it harder to raise equity for folks as well.
Yeah.
So it's sort of circular
Completely.
In a way.
Yeah. So the second big change, Sean, I think this is one that's probably of interest to the people watching this podcast that are investors and buyers too, is on the equity capitalization requirement changes with SBA deals, specifically on the provisions with what you can do for down payment. So just to give a segue to the past. So when the SBA guidelines last changed in 2023, you are essentially now allowed to have the down payment basically come from one of 3 different places. So place 1 is all cash from the buyer and investors. Place 2 is a partial standby seller's note. So basically a seller's note where it's only accruing interest for the first 2 years after closing. And then come year 3 through the end of the SBA loan term, payments are being made over whatever is agreed upon for the payment schedule. And then the third avenue was the classic full standby seller's note. So basically, seller's note that's just kind of hanging out there, accruing interest typically until the SBA loan's paid off. And then after that point, you could either have it amortized out or you could have a balloon payment or whatever you and the seller agree upon. So in the most recent SBA guidelines, the 2023 version, there was no mandated cash floor for them to have cash into the deal. Now, most banks customarily, at least banks that Pioneer Capital Advisory works with, wanted to see at least half of the transaction capitalized from an equity standpoint with cash, and the other half could be partial standby or full standby. Now, lots of searchers were leaning on the partial standby for part of the capitalization if they didn't want to do these big equity raises going to, investors because they wanted to keep as much control in the business as possible. Now, the new SBA guidelines going into effect come June 1st completely do away with the partial standby as an option altogether. So now you have two options. Option one is have the whole 10% down come from cash from the buyer and investors. And option two is the full standby seller's note. Now, to riddle in another monkey wrench here, you now have to have 50% as the cash portion of the down payment. There's no longer no floor. Basically now, if you're doing, let's call it a $5 million transaction, including the purchase price of the business plus other deal costs, you're having to come to the deal with $250,000 of cash, which is half of $500,000. I'll just pause there and hand the mic back to you.
Yeah, so we've been paying close attention to this one, and pivoting from a 2-year standby period and allowing that as a seller note to qualify as a portion of the equity component or the down payment component of an SBA backed deal. Pivoting that to now a 10-year full standby requirement it's a big change.
Huge change.
I mean, it rules out using that structure for folks that are, 75 to kind of similar demographic to what you said about folks that will need to personally guarantee a partial transfer of ownership, right? So both of these dynamics are kind of a perfect storm that seems to me like it's just going to require more cash to close these deals.
Yeah.
In general.
Yeah. So my, Kev, looking at where the puck is now versus where it's going is I know at least these last couple of years, Sean, correct me if I'm wrong, because you're more involved in the equity side, whereas I'm more involved in the debt financing side. It seems like there's kind of somewhat quasi-market terms, if you will, on the equity side, even with these SBA deals where it's if the equity setup is this, the liquidation preference is that, and vice versa. And I think now if you look at the combination of two specific things that are playing in the market, one is you can no longer have foreign capital going to deals. So that limits the amount of just dollars going to SBA finance transactions. But second is the cash floor is getting raised now, where unless you are able to find a full standby deal, and those deals do exist, they just aren't the bigger opportunities. Generally, I'd say there have to be kind of a confluence of situations going on to get those done. You as the buyer have to come to the deal with 10% cash capitalization, essentially. So I think if you just think about Econ 101 back to college, if you have more demand for the same investor dollars, terms should improve. So I think at the end of the day, come June 1st, and with some of the things sifting through the market here, on the margin on the same deal that got done a year ago, you as an investor should be able to get better terms because you have more searchers vying for the same number of dollars. Albeit there are more people looking to invest in these deals every day. But if I was a spitball, there's probably more people entering the buy side than there are the investor side.
Yeah, that's probably, there's definitely a wave on both sides, and we're seeing it.
Yeah.
But yeah, it certainly is, part of what happened is there was a big wave of folks that came in with the intent to structure deals under parameters that would have worked under the 2023 guidelines. And now those deal structures just don't fly anymore, or they do, but they're just substantially harder to get done. So some of what we're seeing is folks have come to us from various, parts of the small business acquisition ecosystem saying, hey, on the back of these new guidelines, we're looking to form more material relationships with equity providers, right? These could be buy-side firms. These could be, searchers that have maybe done a deal and want to do another one and, want to get maybe a different NAICS code SBA loan, or they want to recap their SBA loan so they have more flexibility, things like that. So we're seeing initially a trend towards building relationships earlier with investors.
Yeah.
That's kind of the first directional indicator we're seeing. But yeah, a hypothesis is similar to what you've said is, whether it's better terms or maybe, my initial hypothesis is that more deals are just going to come in front of equity investors. Because my sense is a lot of these deals don't kind of hit the equity market, if you will. They don't come to syndicates at this point because they're able to get the deal done between seller financing, personal capital, friends and family, and then an SBA loan. And that's enough for a lot of these deals. But now, given the new guidelines, that might not be enough. So there's going to likely be more deals that come in front of us.
Yep. No, completely agree. Well, that's honestly, Sean, from my side, that's all I really had to cover unless you have any questions or other content or topics you'd want to chat on here.
No, I think this is great. Really appreciate you taking the time. Any closing remarks you want to make about Pioneer or for the listeners?
Yeah. I mean, right now, as of May 7th, we have close to $84 million of transactions that are taking place in the pipeline. The market may have evolved, the goalposts may have changed, but the beat goes on, and we're here to help facilitate for anyone looking to buy a business needs $1 million or more of SBA financing. And the best way to get in touch would either be my website, www.pioneercap.com, or Matthias, spelled Matthias, at pioneercap.com as well. So we typically get involved either kind of right around the LOI stage, and we're there to hold your hand start to finish. And we get paid only by the SBA bank if you close. So incentives are basically completely aligned.
Great business model. And Matthias, hope to be doing some deals with you soon.
Same here, Sean. Thanks for having me on. Take care.
All right. Take it easy.
Cheers.